Investment Live. I'm Garrett Lale here with the head man of ARPG, Matt Dahl. Matt, good to see you, man. Happy Friday, June 13th. Ready for the weekend.
It's Friday the 13th. We're both clean shaven.
I didn't realize it was Friday the 13th. So you just said that. That is
It's Friday the 13th, and we're both hairless.
Yeah. Well,
don't know what that means, but I feel like we're going to be a lot more aerodynamic going into the weekend.
Well, that's important.
We'll get there faster.
Yeah, that's a good point. Yeah, it's all about you want to be sleek going into the weekend. You got to make sure you can breeze right into it as quick as you can. Well, good to see you, man. We were chatting yesterday. So the macro trends of the market. You said we want to talk about the macros today. So it's the Mac attack, I guess. Macro Friday the 13th on the Intelligent Investment Show. So. What's going on in the macro? We're talking about CPI a little bit, talking about rate cuts, what that means to the market. And you've definitely got a little bit of a, is it safe to say you're a little bit on the optimistic side of consensus on rate cut expectations? That's a sly grin right there.
Big smile.
Yes. I see that sly grin.
Yeah, I'm on the objective optimistic side of things.
There you go. Good catch.
I was waiting for that one. Thanks.
Yeah.
Thank you for that nice little perfect fastball right down the middle. You told me it was coming. Appreciate that.
Well, it's like, have you seen the movie Bull Durham? Let's just go ahead and get completely off topic right out of the gate here. Have you seen the movie Bull Durham? I haven't
seen Bull Durham in I don't know how many years, so I wouldn't remember anything. I did watch Field of Dreams though last Friday night with my son. It was great.
You got to watch Bull Durham again. It's probably been 10 years since I've seen it, but I've seen it enough times that. It's one of those movies that it's got so many good clips and good lines that you can almost just YouTube some clips from it, and that kind of satisfies your Bull Durham cravings, I guess. But one of my favorite ones is when the catcher's shaking off the sign and he's saying, "No, I want to throw a curveball. I want to throw the fastball. I want to throw the fastball." So the catcher, Crash, tells the batter it's a fastball right down the middle, and he hits it in the 15th row. And he's like, "What are you doing?" He said, "I told him." He said he hit that like he knew I was going to throw a fastball. He said he did know it was going to be a fastball because I told him, "Don't ever shake off my signs again. Do what I tell you to do." So yeah. So I gave you the fastball right down the middle. If you miss it, that's on you.
Yeah. So there is a lot of interesting macro trends right now, and I find myself, frankly, I'm going to be a bit holier than thou today. I'm going to,
right.
It's time for us to pontificate. It's time for us to kind of take a bit of for the Intelligent Investment Show to take, I don't know that we're ready to take a victory lap here.
Okay.
But, I think we're running toward it. I hope we don't trip on the way and fall through and fall like 5 feet in front of the ribbon. And then, some kid in a wheelchair passes us or something. So, but that could happen. But here's what's taking place. Back to our Texas Bank Capital CEO, who said everyone is focused on inflation. They should be, because inflation is clearly not whipped. And this was 4 weeks ago? Okay, if that, maybe 5 weeks. And the math didn't support that. It didn't support it then. Doesn't support it now. We don't have the pressures on inflation. The internal components of inflation are not expanding like they were before. Okay. And so let's go back a few shows to our favorite new acronym, the hiccup, right? Which is the European version of our CPI. So it's our CPI. The Eurozone has the hiccup. The only difference is, and it's a good difference, I actually think they do it better than we do, is they remove shelter. What hiccup stands for, HICP, is the Harmonized Index of Consumer Prices. And they remove shelter because if you own a home, you're participating in the inflation. It's not hurting you. Okay. And if you don't own a home, it does hurt you. So it sort of cancels itself out depending on the population that owns versus doesn't own homes. So it's not good data. It's not good, clean data. That's why they don't use it. Okay. So the Bloomberg CPI X inflation, I think, is a really good number. Well, shelter is really starting to cool off, which is why we're getting these real cool numbers. Okay. So if you look at our core CPI year over year, as of May, that just came in on Wednesday, 2.8%. Okay, it's still not 2%. Okay, well, what is it? It's It's 2.8. But if you take the last 3 months, and we've talked about this before, the Fed is not going to take 1 month of data as signal. They're not going to take 1 month of data and go, well, everything's going to change now. We're going to change our tone. We're going to change our tune, and we're going to change our summary of economic projections based on 1 month of data. However, they have communicated that 3 months of data in the same direction is signal. And they will take signal from 3 months, a quarter's worth of data. So if you take March CPI, and this is inclusive of shelter, by the way, so it gets even better with X shelter. But if you take March at 0.06, April at 0.24, May now came in at 0.13 on a 0.28 consensus, you have an annualized CPI inclusive of shelter over the last 3 months of 1.8%. Now, let's go back to the 2.8% year over year number. Let's take that number and remove shelter from that. So it's the same as the European harmonized inflation with the consumer prices, the hiccup, right? What's our hiccup? What's the American hiccup? Okay. 1.5 or 1.5% ex shelter. Okay. So what is that telling us? It's telling us that 4.5% on the upper bound is frankly starting to get pretty out of line. And if they don't step in soon, it could cause a problem. And what I found interesting was last Friday, we talked about this, was the jobs report came in at 139,000 new jobs on a consensus of 130,000. Well, it beat estimates, but the estimate was pretty low. Moreover, March and April combined collectively was revised down 95,000. Okay. So we're starting to see labor, say, don't forget about us either, right? If we keep these rates too high for too long, that's going to obviously cause problems with home ownership and construction and all those other things. And that's something that's very difficult to unwind. So I would like to see the Fed really start to acknowledge these cooling inflation pressures. And I got to tell you, the bond market is again getting ahead of the game. Again, what's the 2-year at?
That smart roommate again.
It spiked a little bit today because of this thing with Iran and Israel, which I find that backwards. I'm not sure why that's happening. Okay, I would have expected people to be running to safe today and yields to be lower today, not higher. But I'm not the bond market. But nonetheless, yesterday it was at 387. So you can make a case. So let's say we finish June at 13 basis points lower. We're at 375 on the 2-year, right? That's fair. That's pretty easy. That's a very easy path to get from 387 to 375 on the 2-year. That's the bond market telling the Fed we need 3 rate cuts because we're at 450 now. So when you start putting the macros together and you start to see, okay, labor is cooling and we're getting revisions down, inflation is clearly cooling. 55% of inflation since the year 2019 has been shelter, and that's starting to cool. We have 500,000 more homes for sale than we have buyers right now across the country. We have a 50% increase in housing inventory in Las Vegas, where we are right now. So clearly we're not going to have, I don't see how with inflation, 55% of inflation since 2019 being shelter with this many homes for sale, and it's clearly a buyer's market now, that we're going to see a reacceleration of inflation anytime soon. But we can't, what we might see is an acceleration of labor contraction, which is I really hope they get ahead of.
Yeah, you got to be careful with the premature victory lap. I will say, I'll caution you against that. I played golf this week, and I got to the last hole, and all I needed to do was make an 8 or better to break 80 for the first time this year. I was really excited about that. Carded a nice 7. I barely made it. But I came really, really close. So you do want to be careful with those premature victory laps. We'll guard against that for sure. So let's get that caveat out there. So you said yesterday the consensus is about 27% chance for a cut in July. Is that right?
Yeah.
Okay.
Yeah. let me see here.
But a 58% chance, you said, of at least one by September, October. What is the intelligent investment projection for July? What's your odds for July?
I would say there's about an okay. So I'm going to be the contrarian here. All right.
Okay.
So the odds of a rate cut for the July meeting is 20%. Okay.
20. Okay. 20.
There's an 80% chance that they don't cut.
Okay. I misread my notes. I saw a 27. Right. It's a 22. That's what I read.
Yeah.
Sorry, I can't read my writing.
Well, but it's changed. Let's call it 20. It's a 20.6, so 21%. So call it 80, 20.
Again, right? We're very precise here. We have to be
precise. We are precise. 20.6% chance.
Okay. 20.6.
So
okay.
I'm going to live in that 20. I'm one of the 20.6ers.
Okay.
Right?
Yeah.
I believe a rate cut in July is appropriate. I really do. Now, if we go all the way through December, where we again have sort of communicated we believe 3 rate cuts by the end of the year, that probability is at 22%. Okay. So at 22% for 3 rate cuts by the end of this year, we maintain ourselves in that camp. Okay. And we're not being a contrarian to be a contrarian. We're making a case of what the data is telling us. The data is telling us that we have this restrictive economy. We have a lot more trade certainty than we had 2 months ago. Okay. Deals are starting to come through. And so, for lack of a better word, not to use, a bad word, but the excuses that the Fed is making for not wanting to cut rates because of the tremendous uncertainty that surrounds trades and tariffs and the regulatory environment, that's going away. And that's frankly, I find it to be a pretty weak argument. Okay. Because uncertainty that surrounds trades and tariffs, that's pretty simple math to do. Okay. It really is. So what's difficult is the labor market contracting. Okay. And we're starting to see, those gophers' heads pop up out of the ground now. Like, okay, we've got some slowing in the labor market, and that can really, we're starting to see a lot of homes for sale. So a lot of people use their homes for wealth, or they have income coming from other properties or whatever it may be, or they bought a home and it was kind of expensive, and now they're thinking maybe I shouldn't have bought this home. Well, now they can't sell it because it's worth less than it was when they bought it. Okay, so these are the tricky parts of having your interest rates be too high for too long, and of course now maybe somebody loses their job, or they can't find another job, or they need, again, maybe their house is too expensive and other parts of their lives are becoming more expensive, and they need to find a higher paying job. Well, now those jobs aren't out there anymore because of what's happening in the labor market. So it's important that the Fed, I think, acknowledges this in next week's meeting in their summary of economic projections, because the Fed meeting on the 20th, which is Wednesday, the 17th, that one does include, that's one of the 4 that includes the SEP, the summary of economic projections. And I would like to see what that dot plot looks like. I would like to see how many of the Fed folks are in at least 2 rate cut camps by the end of this year, and compare it against what we saw in March.
What would it, and maybe you might have just pre-answered the question I'm about to ask, but what would it take for you to change your mind? What would you need to see to say, I mean, you've sort of made your bed for July, right? I mean, you're saying 80% chance, or you're in the 20% camp. So you're expecting a rate cut here. So is there anything that can change between now and that July meeting to make you say, oops, Matt made a boo-boo, and I don't feel that way anymore. Now I am in the 20% camp or the 80% camp, or are you pretty much committed to that at this point?
Yeah. I mean, listen, hard data could come out, right, in July that all of a sudden we created 220,000 jobs, and inflation for the month of June came in at 0.6, then they're not going to cut. Then they won't cut, right? Okay. So there has to be a hard data reason for them not to move. Okay, maybe the trade deals sort of unwind themselves a little bit, and we get back to this uncertain environment, and we get back to what the fund strat guys call a disruption of the covenants of capitalism. Okay, maybe those things take place. So there's a myriad of things that could happen between now and the July 30th meeting that would cause them to not want to cut. Let me be clear. I am pretty sure that the 80% that says they're not going to cut, that's also at least 80% in the Fed meetings themselves. So, I don't think that right now they're going to cut. I think the data that comes in between now and that July 30th meeting will cause them to cut on the July 30th meeting. If not, it'll be the September. Then I think we'll get a September cut, an October cut, and then a December cut. We'll get 3 consecutive cuts, all in a row, all 25 basis points. So I'm kind of of a July, September, October cut where they hold in December, or a September, October, December cut. One of those two scenarios, I believe, is most likely. Of those two, I think the most likely is probably the September, October, December. Okay, but I think there's a chance they will cut in July, and I think they should. I think they should cut. Honestly, they're absolutely not going to cut next week. But I think they should. But they won't listen to me because I wear t-shirts.
Well, it's Friday. You're allowed to wear t-shirts. Do you wear t-shirts every day?
I don't. I usually wear my nice shirts every day, but it's casual Friday. I'm also wearing my new shoes my wife got me, and they're very casual, quite comfortable.
So you're not just going out like a little bit on a limb here. You're kind of when you talk about contrarian, you're not just saying that you think they're going to cut and nobody else thinks, there are not many people think they're going to cut, but you actually are predicting the reason that they're going to cut is that the data is going to change. Am I hearing this right? Like, you're not just saying that the Chiefs are going to lose the next game. You're saying the Chiefs are going to lose because Patrick Mahomes is going to get hurt between now and then. You're projecting a change in the data between now and then. Am I hearing this right?
I'm projecting a continuation of the data. We're now starting to see the hard data, the cooling of the labor markets, the contraction of shelter inflation.
So your contrarian view is in the data itself. You think
correct.
The data itself is the projections.
Well, I think what we have now is we have signal. We've got March and April revisions down of 95,000 jobs. We have May coming in 139,000 jobs. Although that be consensus, we want that number to be at least 165,000, 170,000 to sort of maintain parity. So that's still a low number, and that likely will be revised down too. Okay, so we have 3 months of labor of slowing labor growth. Okay, We've got 3 months now of very cool core CPI numbers annualized out at 1.8. We've got core CPI year over year ex shelter at 1.5. We've got way more homes for sale than we have buyers, which will continue that shelter disinflation or deflation. I don't know that we'll get deflation. We might get shelter deflation, which will obviously impact the CPI number significantly, including PCE. Okay, so I see that data continuing because I see the foundational components of that data maintaining themselves. It took a long time to get here. Okay, so I don't see why we wouldn't get to here from there. However, let's put our equity market hat on for a second. What's that going to do? We have S&P numbers now. Again, they're ticking up for 2026. We're at 298.66, right, for 2026, but that's up a little bit. For the NASDAQ, we're at 797.97 for 2026. That's up a little bit. Okay, so now you start to put these S&P numbers, these earnings growth numbers in. We have the tech sector up about 1% in the last week or so as far as earnings estimates for 2026. Okay, if we start to see that tech sector really start to reaccelerate, their earnings growth really start to reaccelerate, okay, and we start to get this pullback in yields, and we start to get real clarity on these trade deals, the next thing you know, we've talked about the bomb that's been packed, and the dovish Fed and the rate cuts and projected rate cuts into 2026 could be the fuse that lights that bomb. And then that takes us to that 68, 6,900 by the end of the year. And I got to tell you, I had a meeting with my advisors this morning, and both of them told me the same thing. They said, honestly, that feels like the more likely outcome, that we're going to get to that 68, 6,900, because what's going to happen then at the end of this year, right? We're going to see earnings growth start to go up, start to accelerate again, right? We're going to see these yields come in, and we're going to see a lot of people that have been kind of on the sidelines. They've been kind of dour about everything. You're going to get that chase. You're going to get that chase into the end of the year, and that could bring us to that 23 times multiple by the end of this year. 23 times on $300 a share for 2026. You're at 6,900. Okay. Now, Lakos from JP Morgan came out yesterday, and he increased his S&P target to 6,000, which is actually lower than where we're at right now. Okay. So, but he's up from 5,200. But here's again, what I'm getting at is he might not be wrong, and this is that tale of two markets. Okay. I think Lakos is he's a bit bearish for me, but he's a really sharp guy, right? So, what's cases he's making at 6,000? So even if we do have $300 a share consensus by the end of this year for 2026, which is actually higher than where it is now, that's a 20 times multiple. So it's $300 a share at 20 times is 6,000. That's where he's getting that number. Okay, listen, a 20 times multiple on earnings growth of 13.5% is a very strong ratio. That is a very healthy ratio to have. That's a very healthy multiple to have. Okay, but again, you have the cooling yields. So you have lower yields. Now all of a sudden you have this cash that's sitting in these money markets and these savings accounts that a year ago you were getting 5% on. 6 months ago you were getting 4.5% on. Now you're getting 4%. We start getting rate cuts, and the market starts pricing in these rate cuts. We're going to start to price in 3% on that money. Right now I think you're getting about 3.75% on your savings rates. So we get 3 rate cuts. Now it's 3%. Now it's 275. All that money now comes out. Like, I'm not going to leave my money in a savings account, get 2.5%, 3%. Not going to do that, right? Then that money's going to start coming out. A lot of it's going to go into, just simple index funds or something like that. But that could be a catalyst as well. So when that bond market starts to show less competition against the equity side, that could also expand that multiple.
So you just said 23 times at 300 a share, or at 300 for consensus earnings would be 6,900. That sounds rich, and I hear what you're saying there for the reason
it's very
to
rich.
get there. Yeah. So I guess here's my question. Let's say that the bomb goes off, right? We do get that you've been talking about the packing of and we talked about this a little bit yesterday in our pre-call, that you can put all the fuel that you want into a bomb. Eventually you've got to have a spark to light it. Otherwise it's just a really big weapon that's harmless, right? But a fuse changes that very quickly. And you were saying this could be that fuse that we're talking about. So if this fuse gets lit and we end up at 6,900 at the end of the year, 23 times, I remember on a show earlier in the spring or several shows talking about that number compared to the bond yield equivalent, basically, right? Like the inverted, what would be the price to earnings multiple on a 10-year treasury? And when they get paired off, that's a little bit of a sign that we might be a little bit overpriced or a little rich. That banjo string is getting wound pretty tight again. In the scenario you're painting now, would you still feel 20? Like if we get to 23 times in this scenario, would you be concerned, or would that be too rich for you? Would you be not putting capital to work at that point, or would that feel right for where rates would be at that point?
I mean, it would be, listen, timing of the market is, again, we know it's not good. We know it's not a smart move. Yeah. But when you manage money, you're not necessarily timing the market. You're pricing the market.
Correct.
So timing the market is not the same thing as pricing the market. So a good manager, which we all want to try to be, is if you're looking at a 23 multiple for 2026, at the end of 2025. So if on January 1st of 2026 or December 31st of 2025, we're sitting at 6,900 and we're sitting at 23 times earnings. And now we're looking at 2027 earnings at 336 and change a share. We're now at 20.6 times 2027 earnings. We are 20.6 times next 24 months earnings. Whoa. So at some point you have to look at the statistical probability that there will be a reversion to the mean of the multiple of at least 20 times, which again puts you back, would bring it back down to 6,000, which would be, a pretty significant pullback, right? So, will there be opportunity? Yes, but can you get hurt? Can you wait out too long? And then next thing you know, the market pulls back to, yes, anything can happen. But and listen, that's the tricky part. That's where you have to really understand not just the hard data, but you have to understand what it means, where it's going, and what has happened in the past when we were here. What did this look like? What's your typical 1 month, 3 month, 6 month, 12-month return look like when we're at 23 times earnings? And and then if you want to get really nuts, you can fold in what does the VIX look like? What does the VIX term premium look like? Do we see, are we getting backwardation on the VIX now? Are we starting to see a VIX pop on the near term and have it be lower on the out months, right? Because of the time value of money calculation. All of those things. And that is the difficult part of what we do, is looking at the data, making a decision, and thinking about everything backwards, upside down, and inside out to say, okay, if the market is sitting at 23 times earnings and things are okay, but the Fed has cut 3 times and the Fed might cut 2 more times, those 2 cuts are already priced in. Now we might see an acceleration of prices a little bit because, okay, well, housing, interest rates are coming down, housing is a little more affordable. Okay. And that could pull that multiple down to 20 times. So when you're sitting in cash and at 23 times earnings, and if it pulls back to 20 times earnings, you get that, that kind of that 10%, 12% whack, right? You were putting money to work. You were trying to not participate in an overpriced market where there was a very likely chance of a pullback. Okay. So, but again, that's not timing the market. And I don't want people to think that's what that means. It's about pricing the market. It's Warren Buffett said it best: price is what you pay, value is what you get. Okay. So it's important that you're deploying value. You're deploying capital for value. You're not deploying capital for price and for convenience. You're deploying it for the value that you're receiving for that capital. And that's what good portfolio managers try to do.
Yeah, and in all this data, I just want to say this. I was thinking about this when you were talking a second ago. We really need to come up with like our own terminology to use for contraction versus growth versus the middle ground, which is slowing growth. Because if you're watching mainstream media, you can they're really tricky with their words sometimes, and they can tell you something. We've talked about this a little bit on the show too, that it makes it sound really bad, like things are slowing down, the economy is going down. There's a big difference between contraction and just a reduction of the growth rate, right? I'm 5. Maybe I shouldn't share this publicly. I'm 5'7" 3/4. Okay, I was 5'6" in the 6th grade, and then I just totally stopped. Now from 6th grade to now, I have grown, but my rate of acceleration has definitely gone down during that time frame. Now, I haven't gotten to the point in my life yet where I'm contracting, right, to where my dad is. My dad's now 5'6". He was 5'7" a long time, right? So we're not to that point yet. But there is a big difference. And sometimes in your headlines, they might say something in a way that makes you think, oh, the economy's slowing down. Well, it may not be slowing. It's not necessarily going down. GDP isn't going down. It's just not going up at as fast of a rate. And that is important, that you know what that signals for the market, that you know that's part of that formula that you're using to build your projections.
You know what? And I have the term for it.
What's that?
The G meter.
The G meter?
The G meter. We're going to call it the G meter. Where's the G meter at? Here's
I
why.
like that.
First of all, it's based off of Garrett's meter. It's Garrett's
That's right.
meter. The G meter. You're the G.
I love it.
But what it is
I'm sold already. I'm sold on this idea already. Okay,
so
you played
where's
ready.
the G meter
I'm
at,
sold.
right? So you know my incredibly irresponsible and immature hobby of racing cars. Okay, what we have in our car, we have a computer in the car that tracks many things. One thing it has in it is it has a G meter inside of it. It tracks the acceleration rate of that race car. So when I launched the car, for instance, the one my brother's race car, the one we're racing right now, because mine's still not finished.
Still?
But let's say,
Yeah.
so my brother's race car, when he launches that car, it's the G meter spikes. That's the acceleration rate. Okay, the G's, like how many G's are you feeling? Right?
Yeah.
Gravity. So G meter means gravity. So
Yeah.
if you're at 2 G's in a race car, if you're at 2 G's in a car, and you weigh 180 pounds, you have 360 pounds of pressure against that seat.
Mm-hmm.
See what I'm saying? If it's 3 G's, and you're 180 pounds, it's 540 pounds against that seat. Okay,
Mm-hmm.
and so on and so forth. Okay, that's what a G meter measures. It measures gravity. It measures your acceleration rate. So what I'm getting at here is when his car launches at immediate, it spikes to 3.15 G's. Okay, it's put your eyeballs in the back of your head and
Mm-hmm.
through your ears. Okay, but then although the car is accelerating, the rate of acceleration falls all the way through the run in a nice, pretty curve. Okay, by the time he goes through the lights and pulls the parachutes, he's at about 0.6 G's. Okay, so again, so make it easy. If you're 200 pounds, that's about 320 pounds of pressure on you.
Mm-hmm.
Okay, 0.6 is your weight plus 0.6, so you're feeling that. Okay, so but it's still accelerating, right?
Yeah.
And let's just say he had a racetrack that was infinitum, right? And an engine that would never explode, right?
Mm-hmm.
And he just kept going and going, going. Eventually, the acceleration rate would be zero, where the car's gone as fast as it can go. It's not going to go any faster based off of the aerodynamics and the headwinds that are coming against the car versus how much horsepower is the car able to make at that point. There becomes an inflection point where the car cannot go any faster. Okay,
Yeah.
and that is when you have zero growth, zero acceleration. Okay, then of course you have deceleration. Now what happens there is he goes to the lights, he goes from 0.6 G's, and both parachutes come flopping out, and he goes to negative 2.5 G's in a hurry. Now that's contraction. Okay?
Yep.
So when he's going through the lights, accelerating at 0.6 G's, he's still accelerating. Okay, but he's not accelerating where he was when he initially took off at 3.15 G's. But when he shoots the parachutes, he's decelerating very, very quickly. But that deceleration rate, that also does the same thing. He decelerates at 2.5 negative G's all the way down to where he's not decelerating at all. So what I'm getting at here is the G meter.
I love this. This is the best part of the show.
We got the G meter now. So the G meter, where's the G meter? What is the G meter? Is the G meter just sort of what's happening with yields and earnings growth? And it's like a peg ratio type of thing, and what we think is going to happen.
Yeah, we're going to come up with something proprietary and really cool, and this is going to be we're going to make millions off of the G meter at some point. We'll figure out how to do this. But no, I mean you're spot on, because what's really going on in that race car at those points in time, right? In that initial launch when you're at 2G, and I don't know what the real numbers are, but you're going, say, from 0 to 100 miles an hour over the course of 100 feet, okay, or whatever the case may be. That's a lot of acceleration in a very short period of time. Now, when you go for the next 1,000 feet, you may go from 100 to, maybe not in your car, but 300 in one of the NHRA cars. Well, that's 200 miles an hour of acceleration, but it was spread out over a 10 times or 100 times longer distance. So your rate of acceleration is actually slowing. And that's what's causing you to feel those things. If you're riding in a car, which is going to be more which are you going to notice the most if you're sitting in a car? Going from 0 to 50 in 5 seconds, or riding along smoothly at 100 miles an hour? You're not going to feel anything if you're on cruise control going 100 miles an hour, G-force wise. You're not going to feel any, because there is no acceleration, right? Even though you're going twice as fast.
Cruising along, right?
Right.
It's like, honestly, it's like being in a plane. Right?
Yeah.
When you're in a plane, 600 miles an hour, 580 miles an hour at 34,000 feet, you don't feel anything.
You don't feel anything.
But when you're on the runway and you have to accelerate to, especially if you're like in Denver, right, where there's no air, you know, and you have to accelerate to 250 miles an hour in order to get that plane up because there's no oxygen there, then you feel that. And so what's funny is that the race cars are measured in all kinds of increments all the way down the track. So to make it simple for what we're talking about today is the first half of the track. So the track is 1,320 feet, 1/4 mile. So there's 660 feet and 660 feet, the first half and the second half. So this particular car, the first half of the track, it accelerates from 0 to 150, just about 151 miles an hour. Call it 150. Okay. It goes from 0 to 150 miles an hour in 4.5 seconds. Okay. Now, the second half of the track, it accelerates from 150 to 190. Okay. Yeah. So it only picks up 40 miles an hour, but it travels that distance in 2.6 seconds.
Yeah.
Okay.
That's
so
a way better,
faster, but it's not accelerating as much. What we're getting at is the most exciting time is that even though it's not going as fast, but it's accelerating more, is of course the first half of the track. And what we saw in early April after that bounce, we saw the G meter take off.
Yeah.
And now we're up here. Now we're kind of at close to the top of high gear. We're going through the G meter slowing way down.
Yeah.
So
we're still accelerating. We are still accelerating.
Yeah. But it needs to, and there needs to be sort of a, you know,
nitrous boost.
It doesn't have to decelerate, but it has to sort of cool off and then take back off.
Yeah. Yeah. We need a nitrous boost. Well, I think we just introduced a spinoff show. We're going to have the Intelligent Racing show probably coming very soon. I think we spent 10 minutes talking about race cars and 20 on the market, so that's a good balance, I think. But
can I wear my helmet on the next show? I'm just going to wear a helmet the entire time.
I love that. I mean, your hair kind of is its own helmet anyway. We've talked about that.
It is. It's bulletproof.
I've known you for, a couple of years we've been doing this show. I have never seen an alternate hairstyle. It looks absolutely identical every single week. And I have never had the same hairstyle 2 weeks in a row. Mine is completely different every time. So
no, I have a mold I put on my head every morning.
Yeah. I see that. You could sell a hat that is your hairstyle. You know, like, have you ever seen the hats where it's like a visor and then like the really spiked up hair out of it and bald guys wear it? You could sell the Matt hat. And
I know, and I got this great thing going. We could sell it as the Mitt Romney.
Yeah. I like that. All right. Well, we're a little over our normal time, David. That was fun. As always, we are here for your entertainment, education purposes only. We're not telling you what to do with your money, so do not do something stupid and blame us for it. If you would like to speak to Matt and his team at ARPG, you can give them a call at 702-655-8300 or head over to intelligentinvestment.com and learn more about Matt and his awesome team over there. So, man, always a good time. Hope you have weather the rest of Friday the 13th. No bad luck to you, anything like that. And have a good weekend. We'll see you next week. And hope you have a good one, and love the G meter, man. That's the title of this show, the G meter.
G meter. Hey, man, have a good Father's Day.
You too. Happy Father's Day to you and all the other dads out there too. See, that's what you got to catch. You're here to help me catch those things. Like, yeah, I wish people a happy Father's Day. That's a good rule of thumb, and I never remember that kind of stuff.
Well, you know, I also wished you a happy Mother's Day. Yeah.
Did you?
Jerk.
Yeah, well, if we weren't live, I could say something right now, but I can't say this live. See you, man.
First.
See you next time. Bye.
I'm gonna see you.